Hello YouTube, this is Jason, aka Junky. Hope this video finds you doing well. It is Saturday, February the 9th, 2019. It's time to do our weekly review of the market, what happened during the week, what the projections are maybe for next week, and just general opinion of the market. It's not financial advice on this channel, it's just my opinions of the market. I'm obsessed with trading and all types of charts, and I'm just sharing my information here on YouTube. So if you're new to the channel, please subscribe. And follow me on Twitter, and it's at CryptoBitJunky. It's also going to be in the information box. Every week we go live, and you can join the chat. Tell me which charts you want me to look at, and it could be any indice. It could be stocks, currencies, minis, commodities, whatever I can pull up in my trading platform. And this information platform here, this is TradingView. Whatever I can pull up there, I'll analyze the chart and give you my opinion if that matters to you. So follow me on Twitter so you'll know when we're going live, because I announce it on Twitter. Okay, so let's get to the market. As you can see, I was kind of looking at Bitcoin this morning. I'm interested in seeing what happens with Bitcoin as far as how it correlates. Bitcoin's always done its own thing, but typically or eventually, with it being in the same realm as it's basically digital gold, or that's what it's positioning itself to be. It's digital gold. So I wonder what the correlation between Bitcoin, gold, and the US dollar over time. You know, because I think Bitcoin's here to stay, and it's going to be interesting as it becomes a more viable asset class. I wonder how it's going to correlate. Is it going to go up when the dollar goes down, or so is it going to be inversely correlated, or is it going to correlate one-to-one? I don't know. I'm curious, and I was just looking at the chart to kind of see if I could find any type of correlation. So I digress from that. So let's look at the S&P for the week. So if you've been following the videos, we've pretty much been broken record status here. The red lines represent monthly resistance. The blue lines are weekly support. Previously, the blue lines for weekly were up here, which means that the bias was down on a weekly level. Well, we broke that polarity, and the predominant direction on a weekly chart is up. However, we're running into monthly resistance. And, you know, I said on the video last week that when these blue lines change from resistance to support on a weekly chart, typically price, and I think we were right here where this red doji is, typically price doesn't stop there when it's this close. And this is just my experience. There's no mathematical equation for this, but just my experience, price rarely just stops before it gets into this zone. Because it's so much buying pressure going up, there's a lot of momentum kind of left in the market. So if it's enough to change the polarity to up, I figured we'd pierce this zone. And you know, you don't look at these lines as hard like a concrete wall. Look at it more as a pillow. You know, this is the front of the pillow, it's the back of it. It's like a cushion zone. Like price enters here and it slows down and then it turns typically, right? So if we look at a weekly chart, there's nothing really special to look at. Price has come 20% down. This first leg here, it came up and triple topped here and fell further down, and now we're at the monthly resistance zone. I mean, it's not really, this is pretty textbook, and price should slow down here and you should see a reaction. Now the question is going to be, how far down does it go when it does turn, whenever it turns, if it turns. I mean, it still hasn't turned, and let me be clear about that. The previous, I use time to mark trend lines. So what they do is kind of tell you the angle of the run. So this is the angle of the run, you know, kind of up to this point, right? Then it changed. Sorry, hold on. My mouse is really sensitive, so it's hard sometimes to make this work. All right, so then it changed to this. So it flattened out, which means you slow down momentum. Okay, then it picked up a little bit more momentum there, flattened out here, and this is the current upward direction. So the polarity on the chart is still up, and this bounce off of this zone does not mean it's going down here. But what's probably going to happen, time to mark trend lines are dynamic. They change every 2 points. All right, so we're probably going to get some type of a swing low right here. This is Friday, and so this is going to be the angle of the up move. But what's probably going to happen because of the zone that we're in, if you were to bet on it, is that it's going to, come up a little bit here. Now, it could break the high, maybe break a little higher. It could come back and touch, make it a little higher there, and then eventually it'll fall, right? And when it breaks through at this level is where you can look for an actual polarity change and start going short. So I don't look at this as a short trigger. I don't. But I wouldn't buy here because this is in the middle of resistance, right? So that's my thoughts. So it's trading exactly how I thought it would trade at this point, and I just wouldn't buy here. This is kind of a boring time in the market for me because I like to trade reversals at predictable areas, and this one's taken a really, really long time. It hit weekly support back here, and it refused to turn. It just consolidated and then pushed further higher. So there were two layers of resistance here at the time, and we said that I think it's going to turn somewhere up here, and it looks like we've got the beginnings of that, but we'll see how it follows through. But I'm not buying up here no matter really what happens unless it gets kind of up here and invalidates all of this. So that's where I'm at on S&P, QQQ, Russells. They pretty much look similar, so pretty much that's where we're at. I did want to make one point today. I started talking about this a little bit on our weekly live when we went live on Thursday. And so this is the McDonald's chart. And this is a trade that I took on January the 30th. Okay. And I just wanted to show you guys something. When you're trading, there's three components to trading, in my opinion. There's the psychology of the trading. Then there's the actual trading plan, the strategy that you're using. And then probably the most important aspect is your money and risk management. Like all trading strategies work sometimes, nothing works all the time. So you're going to lose trades. It's a foregone conclusion, you're going to lose. Nothing's 100% accurate. So you have to marry a system where the risk versus the reward is at a certain win rate is a profitable thing for you. That's your goal as a trader. It's not about your trading strategy. Buy this dip, use a Fibonacci, use crossing lines on moving averages, momentum plays, breakouts. It doesn't matter what you trade. Everything works, but you have to find the frequency at which what you want to trade is accurate. You need to know the percentages. How if you're trading a 30% accurate strategy, that can be a winning strategy, but you have to use wonderful risk management, and you're swinging for home runs. Now, this is where the psychology component comes into play, because I have to trade a strategy that's right 6 to 7 times out of 10, or it messes with my psychology. I can't lose 7, 8, 9, 10 trades in a row. And they could all be small, 0.25%, 0.5%, whatever, and then you hit the home run, 10% win. I can't trade that way because I don't like sitting at the computer consistently losing and losing and losing, hoping to hit the home run. That's bad for me. That doesn't mean it's not a winning strategy. It's just, you have to marry a strategy that's good for you. But once you find it, the other key component is you have to be consistent. Every trade you take that are of a certain type should look exactly the same. And when you get a routine going and you're consistent with it, you'll find consistent profits. So let me give you an example. I have 10 different trade types, but every single one of them has the exact same core philosophy to them. There are 10 different setups, with the trend, counter trend, double cross, first retracement, buy or sell. They're different types of trades, but the components and the rules to the trade are the same for every single one. So they all look exactly alike, even though they're 10 different setups. And the setups are different based on the market conditions, right? And it took studying and years in the market for me to discover that all the trades, even though they look alike, they're not alike. And I learned that, different trades have different trade probabilities, and I had to drop some of them from my trading plan because they didn't have a high success rate. And so the strategy that I trade, I enter every trade with a 2-to-1 risk reward ratio, and I know my entry I know my exit and my stop loss upon entry of the trade. Now, I will say my exit changes based on where the market's moving. So I have a target going in, but rarely does that target end up being where I actually get out because the market goes a little too far against me. So I move my exit up and I lose. I can't make 2%. I can only make 1.5% or 1.6, or So yeah, so it's dynamic. It's based on the market. I always let the market tell me what to do. I never try and tell the market what to do. I let the market tell me. So this is my McDonald's trade. So for example, here's my entry. All right, I bought this is on January 30th. You see the little red arrow on here because that signifies that's where I entered the trade on this trading platform, right? And so, and full disclosure, this is a paper trading. I use TradingView as my charting software, but I don't trade my actual account on TradingView. But I love the software, so I use this to trade, and I enter my trades somewhere else. But I mirror the trades that I enter into the real account on TradingView so that they're on the screen so I can see them and I can track them. Okay, so this red arrow signifies that I got short on this trade, and never mind the reasons why I got short, but I got short here, and this was my target here, and this from here to here is 2 times as large as here, and this trade worked out for me and I won, right? And I'm not trying to show off the trade. That's not the point. The point is every single trade I take looks exactly like this. Now the range may be smaller or larger. I may be in a position where I'm buying here, stop loss back here, take profit all the way up here. Much larger trade, but this ratio of where my stop loss is to where my exit is the same on every single trade. And like I said, this exit can move up a little bit based on what the market does. Like if this market would have came further against me up here, then my exit would have moved up with the move here. And there's some mathematical equation to that I, in this experience in the market has taught me that this is the safest way to play for me. And this, I maintain about a 65% accuracy in my trading plan. And my wins are on average 1.8 times larger than my losses, which leads me to another point. When you're, okay, so if you're gonna find your strategy and you've got it working, I think it's better to trade more trades than less. And let me tell you why. So every trade I take looks like this. And let's say this particular trade type has a 70% accuracy or 65% accuracy historically for me, because I do track them. And I've showed the chart. Here's my chart. And I just told you I'm normally around 65% accurate, and I'm sitting at 58%. Well, give me the rest of the month to get it up, all right, guys? Don't beat me up too bad. But I track every type of trade I take, and I update my chart. And it's been pretty slow this month, by the way. I think I've only had 3 or 4 trades this month. It's been really slow. But my point is, sometimes there's a lot of correlation in the market, and you'll see the exact same setup on multiple different charts. And you may be inclined to say, I'm only going to trade one. But let me tell you why I don't think that's the way to go. Let's say you have 4 trades that look exactly alike, all right? And you're going to risk 1% on a trade, all right? Now, if you pick one of the trades, and let's say when it's all over, 2 of them were winners, 2 of them were losers, and you picked one, you have a 50-50 shot that you're going to lose 1% of your money in that scenario. Because there's 4 trades that look exactly alike. There's 2 winners in that group, 2 losers. That's 50-50. You have to pick one. You're playing with 50-50 odds. I don't like that. A better scenario would be to put 0.25% risk on all 4 of them. The 2 that you win, let's assume you have a 2-to-1 risk reward ratio. The 2 that you win, you're going to make 1% because you won 2. You're risking 0.25%. So when you win the trade, you win 0.5%. So if you win 2 of them, you're going to win 1%. If you lose the other 2, you lose 0.5%. Okay, so now you've made 0.5% profit on all 4 trades. I'd rather make 0.5% profit on and take all 4 trades than kind of roll the dice that I picked the right trade with a 50-50 shot to make 2%. Because what's sustainable is taking all the trades over time and letting the math add up for you. What can be not sustainable is the market does funny stuff and you pick the wrong trades all the time and all you do is pick the losers. I mean, everyone that's listening to this that's done any trading, you've looked at multiple trades, you took one and you lost it, and then the one that you didn't take, you watched it, boom. And you're like, crap, I picked the wrong trade. Don't pick the wrong trade, pick all the trades. Manage your money and your risk better. Scale, change your position sizes so that you can take more trades and diversify your trades. And over time, it's a more profitable model. Trust me, I know. Okay? And you want to guess how I learned that? I paid a hefty price to the market to learn that lesson, you know. So get your psychology in order. Find a good trading strategy, but more importantly than anything is create some tools to help you manage your risk and your money. Every trade needs to look similar, and maybe you have 3 different types of trades, but type A, type B, and type C, but all A's should look alike, all B's should look alike, and all C's should look alike. And if they don't, you don't take them. And that type of objective and pragmatic approach to trading is the only way to success. So you have to treat it like a business and be very, very structured. And then I'm not going to say it gets easy, but then you don't really fret over any one thing. I took this trade and I won it, and I probably took 2 or 3 other trades like it and lost them. That's how it goes. But in time, using that kind of a mathematical approach and pragmatic approach, you'll be a net winner as long as you have a winning strategy. And you have to make sure that your strategy has the proper win rate and the proper risk reward ratio. So it's a lot of work. You have to create your system. You don't want to just go buy something. You want to create something. You know, and you want to look at the market and don't just go, you know, buy the fish, learn how to fish. So I'm preaching again, so I'm going to end here. So that's my view on the market. That's my view on risk management. Hope you guys like the video. If you like it, please hit the thumbs up button or whatever. And I'll do a weekly outlook for the market maybe on Monday. And I'll talk to you then. So I hope you guys have a wonderful rest of your weekend. And I have a slamming headache. This is a hard video to do. I've been wanting to do this for like 3 hours, but I couldn't do it because my head hurt. So I'm going to go lay down. So you guys, I hope you have a wonderful rest of your week, and I will talk to you next week.